Well, welcome to the fifth Bitcoin epoch. We've had the 2024 Bitcoin halving. Welcome back to everybody who survived the last epoch. It was quite the eventful market cycle. But I also wanted to share a few updates with you. This is Brandon, Crypto Jedi. Uh, just sharing my updated thoughts on where we're at in this market cycle, what I see going on, both for Bitcoin, for cryptocurrencies at large, and macroeconomics. But you can see here my master log Bitcoin chart, historical chart. And of course, we are at. I'm incredibly bullish here after this last halving. What I see going on in the market, I see nothing but just incredibly bullish momentum for Bitcoin. The very fact that we've taken out the prior all-time highs ahead of the halving on the back of the spot ETFs, and the market is now churning through all of that demand or supply, I should say, on the selling supply around this $70,000 level. The market is absorbing that as we speak, and we are getting tighter and tighter market conditions through the halving. Available supply keeps dwindling. So it's all very, very bullish, and there's a lot of things. The halving is kind of the big event within the Bitcoin community. The spot ETF was huge for people that were more focused on the Bitcoin investment thesis. People that are more traditional Bitcoiners are more focused probably on the halving. And then there's a lot of people who are investment macro oriented people that there's a lot of things going on in the macro markets that are also extremely, we'll call it bullish for fixed assets, but not necessarily bullish for the broad market and economy in general. But we'll kind of talk about that. I want to highlight something here. People see this chart from me all the time. This blue or this green box represents my expected bull market time range and potential price. Now, price could actually go above for a number of reasons. It would be unexpected if it were to go above this level. It could stay well below this level, and the bull market could end any time before the end of this green box. So this is not to say that I think Bitcoin is going to be at $420,000 on the 15th of December 2025. It's as good a guess as any, I suppose, but it could be the top could come earlier and higher, earlier and lower, later and lower, but nonetheless, this is my expected trading range for the bull market. So when you see this chart, that's really what this indicates. And so as we move forward in time, as I post this chart in the future on X, Twitter, on Discord, when you see me post this chart, this is really a barometer of where we're trading at. If we're at the bottom of this range, and you're still in accumulation mode, maybe it's a time to add to trades, accumulate. If we're at the top of this range, maybe it's time to look to take some profits on tradable positions, so forth and so on. But this is just a general barometer. As we get to the far right of this, we probably want to be more defensive than aggressive, right? As we get toward the right end of this box. It's the way I look at it, the way I think about it. As far as local price today, this is absolutely astoundingly fantastic price action as far as I'm concerned. The very fact that we took out the prior all-time high ahead of the halving, like I said, and then we've had this very prototypical Wyckoff reaccumulation pattern here. Fantastic reaccumulation in the 61,000 to 71,000 range. Really, we've had this peak above, a little bit of a spring below, and now we're doing the very typical consolidation in this range. We came right up into the 50-day moving average and a very kind of predictable pullback. Got some daily support marked on here. I'm not too beholden to these levels. As long as we stay above this liquidation low at 59,573, everything is all fine and dandy. I posted a chart in Discord. I would love to see price slowly over the next maybe even couple of weeks. Get a few weekly, very small weekly candles. Slowly make its move up to the top of this range. Maybe get an initial rejection at 71, roll back down, and eventually touch the 100-day moving average. If we could touch this 100-day moving average, once it's over here, once the 100-day moving average is over here, if we could get a slow move up into this level and then a rejection and hit that 100-day moving average and then take back off, that would be, I think, the most ideal possible scenario. It will have, let me just show you the weekly RSI real fast. That's something I've been kind of watching pretty close. I've been wanting this weekly RSI to fully reset. And this market's just done a fantastic job of consolidating in here, resetting this. You can see here, I would love to see another dip just like this consolidation over here, just below 70 on the RSI to give us another reset on the RSI and another ability to do another run. You can see in prior market cycles, obviously 2020, we'll talk about this more, but this is the market cycle I hope we emulate a little bit closer this cycle, the 2017 cycle. But you see all the big spikes of weekly RSI and then the resets. These pullbacks are really resetting that. The one thing about the 2021 bull market cycle was all this was a lot of paper Bitcoin and leverage derivative trading that really caused this massive weekly spike. And the market got just so overheated through here that instead of having multiple healthy pumps and resets, we had one massive run, massive uh, funding derivatives, paper Bitcoin being sold by FTX, so forth and so on. That wasn't even really there, and then obviously the crash after the China mining ban. I personally still am of the belief that this market cycle was lower than it normally would have had it not been for manipulation both by China banning Bitcoin mining, which caused a large portion of this move, and then obviously players like Celsius, BlockFi, FTX selling fake Bitcoin. So there's a lot of fake Bitcoin sold here on these spikes, and that all had to get flushed out. So I personally believe that last market cycle was lower than it would have been normally, and the lows were actually probably a astounding opportunity to accumulate way below historical norms, stock to flow metrics, all those other metrics. But nonetheless, what I see happening is just fantastic. I love this that we didn't get too terribly overheated on this weekly. We've had a nice reset. We had a nice a reset on that weekly pump, on this weekly pump. As long as these don't get too overdone, and especially combined with leverage, we can look at that. Open interest is one of the key things that I watch. This weekly reset of the RSI is fantastic. I'm loving this consolidation. I'm going to move this chart up here. I posted this in on X. This is just an overlay of a Wyckoff reaccumulation pattern. Obviously, now one thing I want to highlight with these Wyckoff patterns, I think a lot of people try to follow the little green line, exactly. That's not how the market really works. The market, what's happening is you have a very typical when sellers get exhausted and there's more buyers than sellers, you get a markup in price. And then when there's some level that sellers re-enter the market for any number of reasons, it takes time for those sellers to move their coins and for the buying to absorb that demand. And it's very normal markup accumulation as that new supply is absorbed by the market, and then either another markup, or if the selling pressure overwhelms the available buyers, then you get a markdown, right? So you have the market. This is just normal market behavior. Markup, consolidate as you get an equilibrium of supply and demand, and then as if the buying and or selling starts to overtake the other side, then after that consolidation kind of breaks, then you'll get the markup or markdown. Based on everything I'm seeing, I think it's more likely we get a markup. Nobody knows the future. I don't know certainly if there's any sort of black swans out there that could cause this to be a distribution pattern and a markdown. It could. I think odds are a markup based on market conditions for a lot of reasons. But in this short run, pretty much anything can happen. So this is why also being risk averse with trading even through all of this is still wise. It was still wise to maintain a good risk profile, to constantly watch what your downside would be in the event that you are wrong. For example, for me, I'm being super cautious with any leverage that I would take here because I don't know if this could be a markdown phase, right? So I have to constantly protect my position. I do want to be aggressive. I'm aggressively positioned, but I also am taking opportunities to take some profits, position sizing off the table to protect myself in the event that we are wrong. For example, just this morning, I sold some Riot at 12.50. I had been quite a bit underwater on my last round of Riot purchases. Rotated some other positions into Riot to buy more on the massive dip we had, and now we've bounced back basically right above my cost average. I'm technically in profit. Some of the earlier lots that I bought would have been in a small loss. But anyway, I took some off the table. It's just prudent to continue to do that to manage your positions. But I think we're headed for a markup. That's what I see, and I'll explain why. Uh, Real quick thoughts on I just on the altcoin market. You guys probably figured out that I'm becoming more and more of a traditional Bitcoin maxi. I started with Bitcoin. I got really into Ethereum. Then I got really into altcoins. Being a technologist, I see the interest in the technological aspect of building new things. I can appreciate that there might be space for other blockchains outside of Bitcoin. There's a lot of people that think that Bitcoin only, and I certainly agree with them when it comes to monetary use cases. So when it comes to using a cryptocurrency as a store of value, savings technology, or a day-to-day monetary or currency, I'm all Bitcoin. That's all I care about with Bitcoin. Everything else for me is just a technology play. Is there some room for these other decentralized protocols that do things that Bitcoin doesn't necessarily want to do or need to do, frankly? Is there a use case for those in disrupting technology specifically, and can they have a future doing that? So thought that for a while, the whole DeFi concept and smart contracts and putting properties on the blockchain and selling and buying property, things like that, right? Being able to write uh, data to the blockchain more or less and write smart contracts on that. So I was interested in Ethereum for that for a long time. But even if Ethereum and other similar cryptocurrencies that do these sorts of things well, even if they're successful, the total addressable market for that disruption in that space, I think, is still pretty negligible compared to even like Ethereum and several of the other large altcoins combined, their market cap combined. I think is in the long run, I think they're even overvalued at that, and I think Bitcoin is massively undervalued. So I say all that to say, I'm looking at the Ethereum chart here. This chart hasn't changed for me. I see a high, a higher high, and then a much lower low that takes out all these lows, and then a lower high. And this is a typical Wyckoff distribution kind of setup right here on the Ethereum to Bitcoin chart. And then I've seen it as a perpetual downtrend until we reach a 03634 level that I've had on my chart for, which I think is a prior all-time high. I have to go back here and look. Yeah, I've had that level on my chart for a couple of years now. That's the interesting level to me to see what happens with Ethereum when it gets down there. I probably personally won't ever reinvest in Ethereum. I just don't. I don't see a future where its market cap is able to maintain parity with Bitcoin. I think it will continue to lose value versus Bitcoin over the next several years, and I think there are other more interesting from a technology perspective, purely technology, not monetary use cases, purely technology. I think there are also better projects now out there. So I just don't see I don't personally see a huge future for Ethereum. I think it continues to bleed versus Bitcoin. However, when it does hit this long-term trend line that 03634 level, and it does break this wedge back to the upside, there could be some very good trade setups. And as just a purely a trader in any sort of trading accounts, I would be interested in looking at positions there, but it's not something I'm looking at now. But I just wanted to call out that kind of warning that I still see weakness in the altcoins versus Bitcoin for a while here. And the Bitcoin dominance would be the inverse chart of this. I'm specifically looking at Ethereum as a bellwether of other altcoin interest, but the Bitcoin dominance chart I also expect to continue to rise. When we look at the health of the Bitcoin market, some of the most interesting things to me are always open interest, derivatives, funding rates, and this reserve on exchange, it continues to just absolutely plummet, which is good for two reasons. One, people are getting their coins off of exchange. This has been more of a self-custody move, but it's also the liquid supply available on exchange at any given moment in time is continuing to dry up. That's healthy for the market in general. The funding rates did get way out of kilter up here at 74,000. A lot of retail chasing that pump. I think a lot of retail has been completely lost on this whole move without the 30% pullbacks. The narrative has always been Bitcoin has multiple 30% pullbacks in the bull market, and there simply hasn't been. And frankly, I'm not at all surprised by that. I really do. I think the sentiment was way too bearish, and I think the market the bigger players coming in are doing what the market does, and it's leaving a lot of retail who was casually involved in cryptocurrencies and Bitcoin, leaving them on the sidelines. For me personally, most people that I know out that are invested in cryptocurrencies in some way, very few people I know, very few people that actually hold Bitcoin, actually hold and just self custody their Bitcoin. Very few. Only people that I've got to convinced to do that, frankly, is the only people I know that do that. Everybody else that I know out that's involved in cryptocurrencies, they are all holding some bag of mix of Ethereum and Dogecoin, and hardly anybody holds any significant amount of Bitcoin. And I think this whole market move has been very typical. That's where retail's interest is, and that's why the altcoins are lagging versus Bitcoin as the big money goes to Bitcoin, and retail is just watching Bitcoin rise, and they still haven't been involved. And I think they started to get involved and chase here. Derivatives you see here got extremely high funding rates, got extremely high, and very predictably we've wiped out all that leverage. And a very healthy move. We have some negative derivative prints, which in a bull market like this, especially people are. I mean, it boggles my mind that people are shorting Bitcoin on right after the halving. It just blows my mind. Here's our funding rates, right? I cannot believe that people are shorting Bitcoin. We've got negative funding rates here, but that is what's going on. But this consolidation here at a very low funding rate, very very bullish. Let's go to the macro side. I'll give you a few macro thoughts and I'll try to wrap up this video. So a few things I want to highlight. I talk about this a lot, but obviously the biggest event, again, we've had the ETFs, very bullish, allows a lot more people to get access to Bitcoin in different accounts. A lot more investors can also position their clients with the ETF, so forth and so on. It also legitimizes Bitcoin, right, for a lot of these institutional players. But on the other side, and then we had the halving, very important to people in the crypto space and Bitcoin. But on the macro side, the biggest of all event, in my opinion, is the likely flight away from bonds that it's going to be happening in the next coming years. And I think I say this and people assume that I mean like today or this week. I mean like from now to 2030. There should be a pretty large exodus from paper debt derivatives, aka bonds, treasuries, those sorts of things, for lots of countries, but also namely for the U.S., which is the big one. We already see a lot of international players starting to either slow down their treasury purchases and they're buying gold now or other things, or they're outright selling treasuries and bonds. So I'm watching the macro situation. The U.S. debt is obviously one of the biggest situations. As the U.S. debt gets exasperated, and these interest rates are really causing a lot of pain for the U.S. Debt situation. More and more investors are going to flee bonds because there's the risk. If you look at just fundamentally what a bond gives you is a quote-unquote risk-free return. But if the market starts to understand that the forward expectation of real inflation, forget CPI, real inflation of hard assets like land, gold, Bitcoin, if the real inflation on these assets and the monetary debasement, which is really the measure of the inflation of those sorts of hard assets, if the monetary inflation, the money supply growth outgrows the percentage of yield they're getting on those bonds, it is not a good investment. It's not even a bad investment. It's a terrible investment. And I think larger and larger portions of the market are obviously figuring this out. So what I have here on this chart is the TGA, the Treasury's account with the Fed itself. And obviously we saw when a lot of people were, when the market went in 2022 and ripped up through 2023, the market did not expect it. But what that was is the Treasury was buying down. We went into that government shutdown. The Treasury, when we hit the debt cap, I should say, the Treasury spent down the TGA account, and that's all money that went from this account at the Fed into the real economy, right? And then obviously when the debt cap got suspended and they were to raise money, a lot of us thought we'd have a bigger correction, myself included. I did short the market a little bit, made a little bit of money, not as much as I thought I was going to make on this. I thought there was going to be a massive bond issuance. I thought they were going to issue more evenly across the short end and the long end of the curve. They did. And it did. The rates did come up, and the market did have a minor correction, but it was very very mild. And the reason for that was the repo, overnight repo purchases. So this is I talk about this a lot, but this is the reverse repo market. So this is a place that money market funds can park extra cash if there's not enough treasury supply. So, for example, when the Federal Reserve printed an absolute ton of money and gave that to the Treasury basically in the form of buying Treasury bonds, when the money market funds also, when they got paid out, when they went to go buy T-bills, there wasn't enough T-bill issuance to cover the demand. So this reverse repo facility is an overnight facility where these large money market funds can park their capital and get a yield similar to short-term T-bills without flooding the T-bill market and dropping the rates back down, right? So this is a mechanism they put in place to help maintain a baseline of rates that they wanted to do. And so they would pay an overnight rate here. So this overnight repo account, it obviously it filled up during the pandemic, basically, when there was just money sloshing all over the place, and it reached a peak of $2.5 trillion. And so what the Treasury did when the debt ceiling was suspended last year was, instead of nuking the bond market and just flooding the market with longer term 2, 10, 30-year bonds, they started to do that and didn't go well. So what they did is they really went to the short end of the curve, and they started issuing much shorter duration T-bills. And so these shorter duration, 3-month, 1 year or less, 3-month typically, 1 month, 3-month T-bills, they can issue those at a slightly higher interest rate than this reverse repo facility. And in general, money market funds prefer holding actual U.S. Treasury bills versus having their money parked in this overnight repo facility. And so these money market funds have been aggressively, as the Treasury, I should say, as the Treasury has been aggressively issuing debt on the short end of the curve, this reverse repo facility has been getting drained as money market managers predictably are moving from the reverse repo to the Treasury general account. Now, it's kind of flatlined here on the drawdown of the reverse repo, and the reason is you see right here this little spike. This was the this was the Treasury receiving tax payments for the past year. So there's a net inflow right through April as big capital allocators have to pay their taxes for the past year, and there's a large influx. So the Treasury has had a nice influx and the stock market did very well last year. So you get a lot of tax money coming in, net coming in April. Now, the smaller players, retail players, get tax refunds, but the really big players are waiting to pay out. They have their money parked in places like the reverse repo or treasuries, getting yield until the moment they have to pay out to pay taxes, and then they pay their taxes right here. So we are sitting close to 800 billion roughly in the Treasury General account. I've had a bunch of questions about what happens when this reverse repo facility hits zero. And that's when the fun really starts. But it's not going to start the day this hits zero, and I think we're going to slow roll this into zero through the election. If you look at the tax receipts coming in were pretty strong. So we're up to 800 billion in the Treasury General account. It is currently April. They really need to engineer a decent monetary situation and not allow the stock market or anything else to crash between now and November for re-election reasons, right? This is just a very typical re-election cycle. So there's a couple levers the Treasury still has ahead of them. First of all, there is $435 billion in this reverse repo facility, and they have 800 billion, so that's 1.2 trillion dollars available to them between these two markets to continue to spend through the end of the year. So what I suspect is going to happen is you're going to see the TGA get spent down a little bit into the election as necessary to support the markets as this reverse repo gets closer and closer to zero. So my guess is that we actually kind of slide here on the TGA while the reverse repo continues heading towards zero. I think they can probably engineer it to get them roughly through the election, but it's going to be tough because the debt situation is just getting just more and more insane. There's going to be a new print on this. This is the federal government current interest expense expenditures, right? So basically, as of Q4 2023, the interest expense has eclipsed $1 trillion. That means that for the full year of 2024, it will be at a very baseline, roughly $1 trillion in interest expense for the debt for this year. Now, that is probably going to we're going to get another print here. This was it came out January 25th. It's currently August 24th. So here in a couple of days, we're going to get another update for Q1, and it will probably be 1.2, 1.1, 1.2 trillion in interest expense. By the end of the year, it'll be closer to 1.5, and if interest rates stay high, it'll be closing out 2 billion before you know it. But the point is, the deficit spending plus interest expense is reaching historic proportions, and we're adding nearly $1 trillion in debt. I think it's every roughly 100 days. So the between now and the election, we've got almost $2 trillion in debt that need to be issued, and there's only $1.2 trillion available between the TGA and the reverse repo facility. So, as of right now, they won't quite make it to the election until they run out of reverse repo, they run out of TGA, and they have to start issuing on the long end of the curve. Or just rates in general will spike. Short-term rates will spike if they keep hammering the short-term T-bills issuance, but they're going to probably balance that out to issue across the curve more evenly and issue more 2, 5, 10, 20, 30-year bonds. But as they flood the market with issuance on that to get the rest of the way through the end of this year, then rates should go up. When rates go up, fund managers rotate from, and the 60/40 portfolio managers, they'll rotate from stocks and equity positions to be a little bit more overweight on the fixed side, the fixed income asset side. So that's kind of the expected move. Now, there's a couple of the levers that are being talked about that I think are going to be pulled before we get to November. And I think it's all this soft talk by the Fed with all the Powell coming out and kind of saying that we think there's going to be rate cuts and maybe we have to wait a little bit. And he's been kind of soft talking. I think he knows that they're going to have to cut rates. They're going to have to probably also, banks are probably going to continue to come under pressure with these high rates. They're very, very underwater with the current bonds that they hold, especially the smaller banks. So there's still support that's needed for a lot of the banking sector as more and more money continues to rotate from bank deposits to fixed assets, money market funds. So we're going to have a lot of things. I think the Fed is going to have to front run this problem, or they're going to be told they have to front run this problem of there not being quite enough cash between the TGA and the reverse repo to make it to November. I think you're going to see a rate cut, which is going to help help with when they start issuing this flood of T-bills and bonds. If the Federal Reserve is cutting interest rates through that, it's going to help buffer and help the market absorb that larger incoming supply, because they're going to see that the rates are going to be decently above the prevailing overnight Federal Reserve rate. The other thing that the Federal Reserve will probably do is they very well might institute some new four-letter programs to help support banks, which the BTFP program was basically a shadow QE program anyway, right? To help support banks. So I think that that's probably what's gonna be coming, a combination of that, and then also they're talking about increasing the supplementary reserve ratio for banks, so that banks, instead of having to hold, they can only hold so many government fixed assets, fixed debt instruments on their balance sheet for the reserve risk rating. If they suspend that, and that allows banks to buy a lot more T-bills, bonds, so forth and so on, that will help immensely with the ability for the market to absorb a large amount of incoming longer-term bond or T-bill issuance, a combination of once that reverse repo is drained. So we'll continue to watch the TGA balance, the reverse repo balance. I bet before this hits zero and before this gets drained down too far, you'll see the Fed find some excuse to lower rates. They will have an excuse to lower rates. Now, is it prudent? Is it the right thing to do, given they're supposed to be fighting inflation? No, of course not. That's going to reaccelerate the economy, and inflation is going to come back earlier. But inflation is going to come back one way or the other. Like the inflation is not going away when you have interest expense this high, when you have debt to GDP this high. It is simply not going away. And the last thing I want to highlight here, this is why so many people have been perplexed. Why is the market still going up and the economy hasn't crashed into a mega depression after going from 0% interest rates to 5% interest rates? Well, it's really extremely simple. It's really, really, really simple. When you raise interest rates, when the majority of the debt is actually held by the federal government, which can print money at will, and they have no no sort of natural limitation of what they can spend. You see here the debt to GDP is well above 100%. It says officially 120%. I think it's more like 130, 40%. But there's a lot of unfunded liabilities. So, Medicare, Medicaid, all that stuff, all uh, those programs are massive, and they're unfunded liabilities. It means that they don't show up on the debt to GDP. But the debt to GDP is probably realistically more like 300% with all those unfunded liabilities, okay? But nonetheless, the official debt to GDP is above 120%, and this is what they have to pay. This debt is what they have to pay interest expense on. So the debt to GDP is above 100%. So when you raise interest rates, there is more pain on the Treasury because of the federal debt than there is on households. And I'm going to show you a chart that highlights that extremely well. Everybody thinks that households are, I see a lot of bear posts on Twitter and X saying that households are under immense pressure and they can't afford the interest rates, and this is why the economy is going to come crashing down. All you need is this chart right here to tell you that is not the case. Okay, ever since the pandemic, actually before the pandemic, since the great financial crisis, consumers have tightened their belts and have been in a much better situation. So this is the inverse, right? So you see here, this is what this chart is a percentage of debt payments to disposable personal income. Now there are other charts that also show net assets. So the valuations of homeowners, obviously their values have gone up and they're all locked into these 3% mortgages. It's a fantastic arbitrage on monetary debasement. So they're getting the advantage of the value of their house going up while their debt is staying fixed, and they're actually slowly paying it down at a much lower interest rate. But ever since 2007, and this peaked out at above 13%. So 13% of disposable income went to debt service payments in 2007, and then that was kind of the height of the party. And then when that came crashing down, since 2012, since it kind of bottomed out here, consumers have maintained up to the pandemic a much more responsible balance of debt to disposable income. As not intuitive as that seems, that is the real case. This is the real case for the consumer. So the consumer, what this is telling you is that the consumer is able to take higher interest rates and than the government is. So the government is up here, right? The up is bad. The higher, the worse it is. This is the federal government's debt problem, roughly, right? The debt to GDP, right? That's their income, the debt versus their income, and this is a key metric for consumers: their disposable income versus their debt. It's the opposite. Consumers are much more responsible than the federal government because they have to, because banks won't lend them money. Frankly, ever since this. What's going on here is the banks have forced consumers to be more responsible because they simply won't lend consumers more. This was all driven by irresponsible bank lending, frankly. Banks simply will not lend to consumers the same way. So that means that the consumers, by force of the bank lending, are more responsible now. And then obviously when everybody got free checks in the pandemic, we all got incredibly responsible apparently because we had a bunch of free money and we no longer had to commute in traffic and everything else, and so we were able to pay down debt even more. And ever since then, of course, it's bounced back a little bit, but it is still below this 10%. But you can see here, obviously the problems really started above 12%. We've had these few spikes above 12%, and that was very problematic. Below 10%, consumers are super healthy. Above 12%, they're starting to become in danger. So we're in a super healthy state for consumers. Households are fine. Households can deal with 5% interest. 5% interest isn't that high. Historically, 5% interest is extremely low. Over here in the 80s, it was nearly 20%. So the consumers survived somehow. 20%, I know it's probably difficult, but we're only at 5% interest rate. Consumers can deal with 7% mortgages. That's okay. Consumers can actually handle that because they make a weekly income. Most of them are wage earners making a wage, and so the hit of that isn't as big as it sounds like by a lot of people. But the hit to interest rates for the federal government is much, much larger. And this is going to continue to widen. Now, I believe because of bank lending programs, I think you're going to maintain this. Consumers are going to be forced to be more responsible with debt because of the way the banks simply won't lend to consumers like they used to before the 2008 crisis. So I think you're going to see this. Consumers are going to be forced. Now, whether they want to be, maybe they might try something. And individually, a few people might get over their skis. But in aggregate, U.S. consumers and households are in a very actually solid position of their disposable income to their debt servicing payments. The federal government is not. So, very simply, what that means is interest rates are bad for the government. They have to pay more interest expense. This is all pre-stimulus, and this is stimulus for rich people. When you look at it's not that every Tom, Dick, and Harry is getting the benefit of this interest expense, but people who hold government debt, baby boomers, pension funds, 60/40 allocations, international monetary funds, sovereigns, so forth and so on. They're getting they're getting over $1 trillion a year now in interest expense that they can then turn around and rebalance their portfolios and buy fixed assets with. And that's largely what's happening, right? Especially banks and things like that, as they're forced to buy this fixed debt instruments, they're getting paid out by the end of this year close to $2 trillion. They're gonna recycle some of that back into the fixed market, but they're gonna rebalance the majority of that. You just take a 60/40 pension fund. If they're getting paid the interest are getting paid on this side, they're going to rebalance 60% of that over to the equity side potentially, right? Depending on what equities are doing versus fixed assets in general. But nonetheless, you get the idea. This is money that is going to mostly wealthy people in retirement accounts and other sovereigns, and that they can then turn around and spend this money. So it's outlay for the federal government, and it's putting real money into the real economy, while the consumers are obviously able to handle this 5% interest rate just fine. And you see the spike to 5% interest rates, just in general, you look at this chart, that hasn't created a large increase in debt service payments. And that's largely because, again, as interest rates rise, banks are still going to be super cautious about lending. And so this is still banks being cautious about lending, and this is also a derivative of so many so many people being stuck in their 30-year 2% mortgage, right? And so this is the reason why. This is the reason why the markets. Let's go just the S&P 500. I talk about this all the time. I think it blows my mind that people on X just do not seem to get this. This is why this has just gone up and up and up. This is that interest expense. This is that $1 trillion coming in a year and getting funneled right back into the equities markets. That's exactly what that channel is. And then this is a very predictable channel breakdown, pullback. It'll probably pull back and consolidate, and then we're going to probably resume here before too long. For example, like the Nasdaq probably will hit the prior all-time high. Good support test, good reset, and then probably a resumption. But the reason I say probably a resumption is because nothing is changing with this picture. There is nothing. The only thing that's going to change with this picture is this reverse repo running out. And when this reverse repo running out, there's going to be a short term potentially, depending on, and it totally depends on what the Treasury does and what the Federal Reserve does. So there's a lot of things that can be changed. But potentially, we see a bigger spike in rates, which, when the rates spike, just like what's happening right now, you get the 10 years up a good amount, and equities are pulling back. So this trend will likely continue until the Federal Reserve comes in and caps rates. When that happens, that's the big event. That's the big event whenever they won't say they're doing it. They're not going to officially say they're doing it. They'll invent excuses for a bunch of 3 and 4-letter programs to cap these rates and start buying government debt to help the Treasury out. But when that happens, when astute investors figure out that's what's going on, they are going to rotate out of bonds, because when this gets capped, what happens is the Federal Reserve is printing money out of thin air to buy government debt, that's money that's going to get injected into the real economy through government spending. That's going to push up inflation while capping the returns that bond investors are going to get. So bond investors are no longer going to be interested in buying government bonds. The Federal Reserve is going to have to buy a larger and larger percentage of the government bonds as people quit buying them, because as inflation forecasts go above, say the Federal Reserve tries to cap rates around 5%. As soon as astute investors think that the long-term real inflation of real assets like gold, Bitcoin, land, energy, byproducts, so forth and so on, when these things when the real inflation on those, when the monetary debasement is above that 5%, when the monetary debasement continues to be 7%, which it has been, and that's going to go straight into all those hard assets, they're going to quit buying this. And what happens when they quit buying this, they start buying fixed assets. And especially when people start to net sell, when they say, okay, I need to get out of my fixed debt because I see a situation where I'm actually going to be losing, versus inflation. That's the big event. I expect that to come in waves. I don't think it's going to be it's not going to be that everybody's going to try to sell their bonds on some event and rotate entirely into Bitcoin, and Bitcoin's going to go to $10 million and the bond market's going to go down, and the Federal Reserve's going to have to buy it all overnight. It'll come in waves, and very likely come in 4-year election cycle and 4-year Bitcoin cycle looking type waves. But it's already started. We already see, again, for the millionth time, we already see large foreign entities either not buying or selling their U.S. paper assets, bonds, and buying either gold, fixed assets, doing trade directly in other currencies, a million other things going on. But we see this rotation already. Large reason why Bitcoin's up a lot is the early astute investors have already started to sniff this out, and clearly that's why gold broke out, right? So like for the 100 millionth time, I think everybody's talking about this, but gold broke out. Gold probably will have a big run. I'm going to guess gold goes at least 3,000 or something. That's my guess. I don't know. I don't track gold that close, so just ignore my analysis on that. It's just a basic guess that I have. I think you've got like a pseudo parabolic curve that's going to form until it reaches a kind of a crescendo here pretty soon. Hold on, let me try to just you get the idea. That's what I see going on. These pullbacks are very normal. It should pull back, consolidate, next leg up, But we've exited on gold a massive consolidation period, just like what's happening on Bitcoin on a much smaller scale right now. But these breakouts typically have legs, and it'll be a market pivot for a while. But that's what's going on. That's exactly why gold's breaking out. It's largely why Bitcoin's up, and that's exactly why I'm so bullish on Bitcoin for the rest of this year into probably next year. There's a lot of theories. This video is going way longer than I thought. There's a lot of theories out there that the Bitcoin market cycle might be shorter, and I wouldn't be surprised if that was the case. And the reason I wouldn't be surprised if that was the case is the election cycle, namely, if the Federal Reserve is working with the Treasury and they're again spinning down the TGA, draining the reverse repo, that's all just cash that's going to get pumped into the system, pump up asset prices, and put a structural floor under inflation. And then if the Federal Reserve comes in, starts lowering rates, starts supporting the Treasury in different ways to get through the election. Once we're through that election, the incumbent, whoever that is, will have the option of taking some early pain early on. They just got elected. They can come out and say, okay, we've got to do these programs, whatever it is, for the first year or two to get things straightened out. It's a big mess out there. It could be even Biden if he's reelected, or it could be Trump, whatever. It doesn't matter. It doesn't matter who it is. It doesn't matter who's in office. They have the option of saying, okay, let's just take, and they can let things kind of reset early in their tenure, let rates get high, let the equity markets come back down, let the Federal Reserve cap rates, help inject liquidity, and kind of recycle and reset, and let inflation spike basically for the first couple of years, and blame it all on the past guy, or blame it all on something else. I don't know, but and then try to fix it toward the end of their tenure, right? That's the option that they're going to have. And so if that happens, if they let rates really, really rise, and they find other ways through the bank leverage ratio to help banks buy the government debt and everything else, we could have a situation where we have a pretty short-term precipitous rise in rates and a drop in risk assets, and Bitcoin could drop with those risk assets. But on the back end of that, it could get just absolutely wild in the next market cycle. I would, and that's the thesis, that we're going to have a top in Bitcoin at the end of 2014. Let's just be clear what I'm talking about. And there's logic. I will get this little chart, close that one. There's logic in that. We've already had a huge run, taking out the prior all-time highs. We could peak in 2024, right around the election, not long after, and then pull back, and that be the end of this whole cycle. It could happen. my my gut tells me that we're going to have the problems that are going to be put off until after the election are more net inflationary, and I think it's the other way around. I think what's going to happen is we're going to have a probably a pretty casual rise up into the end of the year as equities, Bitcoin, gold, these type of assets will continue to run, and I think a lot of people will think that maybe we're at $120,000 Bitcoin or whatever it might be at the end of this year. A lot of people might think we're at the top, probably get a nice pullback, after the election sometime early next year to 100,000 or 80,000, and then I think all of the stuff we're talking about, the debt situation, compound, all these issues, I think that that's actually going to send. That's going to be probably the time that you get a lot of flight away from bonds after that new incumbent's in and after they start really trying to have to deal with the problems they pushed off. They're pushing problems off right now, right? So they've got enough money in the TGA. They've been draining this reverse repo. They're pushing off this acute issue of interest expense right now. They're going to have to deal with this issue. And so on the backside, the actual dealing with that issue, I think is a 2025 thing where it gets really acute and people really realize the nature of the debt situation as the new incumbent is trying to maybe deal with that position for their legacy for that. And that's when you have this big, just massive rip roar and move as you get, that flight away from bonds and government debt into fixed assets. So that's kind of what I'm looking at. I wouldn't be shocked if it totally depends on a bunch of levers that are going to be pulled by the incumbent party and what kind of pressure they're going to put. Namely, really what it boils down to is the government is going to spend like a drunken sailor regardless of who's in office, right? It doesn't matter if it's Trump, Biden, or somebody else. The debt, there's nothing that's going to be drastically changed about the spending, government spending, anytime soon, especially with these unfunded liabilities. It all depends on what kind of pressure they put on the Federal Reserve, how they try to squeeze banks into buying government debt, all these sorts of things, and which direction do they let natural market forces take over and inflate away the debt, or do they try to cap it and do a bunch of programs to cap it and really cause rates to go up and long-term rates to go up and the equities markets to come crashing down, risk assets come crashing down. There's a lot of ways it could go. So I guess obviously be prepared for anything at the end of this year. We'll continue to analyze the markets, but my suspicion is that it'll be more of a engineered, slow and steady grind up on these assets into the election, and then after the election is actually when you get the big spike up in these assets as all those issues become more and more clear with what's happening with the debt situation. And so I think 2025, my current feeling is that 2025 is going to be the big event for Bitcoin. That's what I currently think. That's going to be the biggest appreciation of value in this market cycle. So that's my current thought. Not financial advice. I'm just updating a video with a bunch of my thoughts. It went way longer than I thought. Hopefully in the future I'll do much shorter videos and make them more succinct. But I didn't get a chance to go live for the halving the other night, so I wanted to do something for the halving, get some video out. I posted this too. As one last thought here of people who are freaking out over low time preference. This is the prior monthly resistance from the 2021 cycle, 61,500. Very, very healthy. Blast through that, close a monthly above it, pull back to it, and that's probably going to be the bottom of our range. And then off Bitcoin will probably go for the remainder of this cycle through sometime this time next year and into late next year is what I'm currently thinking. All right, guys. I hope you found this beneficial. I would say like and subscribe, but I don't really care at all. If you know people that you think that this analysis might benefit, send them this video. Is about all I'll recommend that you do. But I'm purely doing this for the community. I do not at all care about number of followers or monetizing any of these thoughts. I'm just sharing my thoughts here. All right, everybody take care. Bye.